Hey, I'm Dan Pascone, CEO of Tailored Wealth and host of the Making Sense of Your Money podcast, where every conversation is built around one idea. Your money is a tool to design and live your version of a rich life. If you just filed your taxes and felt that gut punch moment, the one where you realize you paid way more than you think you should have, or the bill was just way bigger than you expected, well, you're not alone. I hear it from every year from executives and business leaders who are doing everything right on paper, but have no proactive plan around their taxes. And the frustrating part is the window to actually do something about it is pretty short. And the motivation often fades fast, the numbers go cold, and most people just quietly lock in the same mistakes for the next year. So this is a solo episode and it's built specifically for hiring executives who want to use their tax return for what it actually is. Not just a filing requirement, but a diagnostic document that maps out exactly where your financial plan is working and where it isn't. I'm walking through 11 specific moves to make right now in the next few while it still matters. And before we get into it, make sure that you're subscribed on your favorite platform, and if the show has been adding value for you, I'd really appreciate you leaving a quick review. It goes a long way. Thanks very much and enjoy the episode.
Brought to you by Tailored Wealth, helping business leaders live their version of a rich life.
Welcome to another edition of the Making Sense of Your Money podcast, where we cut through the financial noise and help business leaders to make smart, confident money decisions. Of your money. This is the second solo edition that I've done in the last month or so, and this was based on feedback from our audience, from many of my connections, and some of our clients. So the last edition was all about company retirement plans and optimizing your contributions in quarter one. And now, as I'm recording this, it's early May, and this one is going to be all about post-tax return strategy. So specifically speaking with higher earning business leaders and executives that have just filed their tax returns. I know I've had a number of conversations like this with new clients, prospects, folks within our community and followers that have come to me and said, Dan, I paid way more in taxes than I feel like I should have, or I was surprised by my tax bill. What can I do about it? So we're doing this edition to help you figure out what you can do about it. So let's talk a little bit about the tax return, and let's focus on what you should be thinking about next, so you don't feel the same way next year around this time. Okay. So first of all, most high earners don't necessarily realize that when you file your tax return, you actually get back a really, really useful and important document that you can utilize all year to do proper financial planning. Okay. Oftentimes, there's like this crunch to get the taxes done. There's a review, maybe a brief one, around what actually happened in the return. Did I get money back? Do I owe money to the IRS, to the state, et cetera? And then you kind of put it away, file it away in the proverbial or digital drawer, and you come back to it maybe a year later. Well, the reality of it is if that's your approach, you're never going to achieve proper tax planning execution, because your tax return is really a diagnostic document. It's a breakdown of many of the financial decisions that you've made within the last 12 months. And it allows you to evaluate where you may have made mistakes or made good decisions. But most importantly, what's done is done. Now you can use that document to help you plan for this year and certainly into the future. Okay. The document's going to show you things like your real tax rate, your equity comp exposure, if that's a piece of your compensation plan, whether your withholding is dangerously off. I've had a few new clients that have come to me and said, I owe way more to the IRS than I thought I did, usually because bonuses or equity events hit and the withholding on those was not in line with their real tax rate. And that's a common mistake. And what that does is it forces you oftentimes to dip into assets or buckets that you didn't want to dip into to pay for that tax exposure, right? So making sure that that's in line, especially when you have these lumpy income experiences, is really, really important. Okay. And then The last thing I'll say as far as a mindset and a motivation is concerned is that you are now probably in a window where taxes are front and center. That window is going to go away in very short order if you're like many of the executive leaders that I work with. So, as the motivation fades, as the numbers go cold, you end up just locking in a lot of the same mistakes as last year. So, use this opportunity right now to plan smarter for the future. And there's a handful of things that you can do in order to ensure that you are planning for the future effectively. Now, I'll give this caveat as I do with any more technical episodes that we do. This is not individual tax advice. I am not diagnosing anyone's situation. I'm simply sharing strategies, moves, tactics that I've seen work very, very well with our clients in the past. And if your situation is similar, these are some things to consider. Okay. So that's what we're going to get into. We're going to get into some specific moves. Before I do that, I think it's important that you sort of establish a planning mindset around taxes because if it's a once a year experience, you're never going to optimize your tax situation. The tax code, as I say, is built for first and foremost business owners and then secondarily investors, right? So if you own some form of business, you have a lot more optionality. But if you're an investor in any way, shape, or form, you also have many different options, right? Even if it's that you've got a taxable brokerage account, there's a lot of things you can do there. But and then where I was going with that is last is the W-2 earner. They are sort of lowest on the totem pole when it comes to optionality from a tax perspective. But everyone, even the high income W 2 earner, which tends to get the shortest end of the stick when it comes to taxes, everyone can do proper tax planning for the future. So you may have a few levers that you can pull right now, but you're going to have many that you can pull into the future, especially if you're planning for some version of retirement, whether that be what I call hybrid retirement or a full traditional retirement. Most of the wealth that I see lost is due to paying more than you have to in taxes in retirement. So that's just something to think about. And then the last thing I'll say before we get into the tactics is if you work with a financial advisor or planner and you're not sharing your tax return with them, you absolutely need to. And I would suggest that they really should be asking you for that. We have incorporated tax filing services into our business for that very reason. So we don't have to go chase around and get tax returns from our clients. In fact, we're considering utilizing a new software that's going to do it automatically. Check out our last episode to hear more about that software because we have the founder and CEO on talking about that. But anyways, you need to be sharing that with your financial planner because if you're not a business owner, and some business owners likely have a regular cadence with their CPA or their accountant, but if you're not a business owner, you're just a W-2 executive, you likely have a one time a year meeting experience with your CPA. I know I was a high earning executive at one point in time. I met with my CPA once a year, and it was always a backwards looking experience. So, if you want to get forward focused planning, it's typically your financial planner that's going to do that, but you need to arm them with the data. You need to give them the return. Most planners have great software nowadays that you can take a look at the tax situation and make tactical moves for the short term and the long term to improve your situation. So that's my little plug there. Okay, so let's get into it. Planning is obviously the key component here, and that's going to be woven into this. So let's walk through these. I'm going to give you some ideas and some thoughts as we go through them. So the first one, and these first three, I always suggest are do them right now. While the numbers are fresh, don't wait till next month. Book some time in your calendar. That's always the best tactic for me is if I want to get something done, you got to book a block in your calendar. And these tax return tactics can be booked right into the calendar and can be effective strategy. So first off, review your effective tax rate. Open the return and find the line showing what percentage of your total income actually went to taxes. Then compare that to last year. Did it go up? And if so, why? Well, did you just have higher income? Maybe you got a raise. Maybe you took on a new job last year. Or maybe there were more equity events. Maybe there were a different bonus structure. Maybe there were fewer deductions,
Or maybe you just didn't do any proactive strategic planning at all. And if that's the case, well, that's a light bulb opportunity for you to think about that for 2026 and beyond. So that's number one. Number two is check your withholding for this year. I mentioned this earlier. I see this all the time, specifically with executives that have lumpy income, meaning they either get commissions, they get bonuses, or they have equity events. Those are the biggest triggers when it comes to withholding being off, because those events typically withhold at a much lower rate than your real tax rate. Your real rate is likely much higher than, typically they do withholding at around 22%. That's going to vary a little bit by the company, by the state, et cetera. But those are some things to consider. Okay. So when you're looking at your return, you want to look at your full income picture, your base, your bonus, equity events, investment income. What's your spouse's income like? Maybe the spouse's income changed last year. Investment income is a big one, right? If you have taxable accounts, you could be paying a fair amount in capital gains, and there are certainly ways to lessen that with different strategies. We'll save that for another podcast, but a lot of tax loss harvesting strategies can be utilized to help that. So apply what you see from last year and look at it for this year. What's going to change? Is your income any different? Is your bonus experience, is your equity experience any different? If you got whacked with capital gains last year from your investment accounts, you should consider utilizing some type of tax loss harvesting strategy. Okay. Or the flip side of that is if you very much over withheld and you got a big return back, it may feel good in the moment to say, I got a big return back from the IRS. But what you just did was you gave the IRS a tax-free loan for the duration of that year. That was money that could have been in your accounts, earning at minimum interest, hopefully earning, returns in the market that you let the IRS hold on to. So fix that. If you got a large enough return, I would opt to adjust your withholding so that that doesn't happen and more money is in your pocket throughout the year. What we always strive for when we have a client that changes job, I did this yesterday, we always strive to get a neutral return. We want the return to be zero if possible for a W-2 leader, right? Because we don't want you to owe a bunch of money that you might have to tap into accounts that weren't set up to be tapped into to pay that exposure. But we also don't want to give the IRS a tax-free bonus. Okay, so that's number two. Number three, pull Schedule D and review your capital gains. Every capital gain and every loss you realized last year lives on this page. Was the tax impact intentional, right? Did you sell securities intentionally? Or did gains stack up on top of ordinary income and push you into a higher bracket, which is very common? Were, as I mentioned earlier, losses harvested effectively, or did you leave money on the table? One tactic that we're talking to a lot of our higher earning clients about is this tactic of direct or custom indexing, right? If you've got a taxable account and let's just say you're buying ETFs or you're buying indexes, that's certainly a great strategy from an investment perspective. It's a great long-term strategy. But if you're realizing either a fair amount of capital gains or you have no capital losses, that's where you really separate yourself. Having no capital gains is one thing, but having capital losses allows you to tactfully sell securities and actually reduce that tax liability. So that's a concept we've been talking more and more about. It's called customer direct indexing. I produce a bunch of content on it. So feel free to check that out on my LinkedIn page or our YouTube channel. All right. Next, so those three, I would say, do those right away. These next can be sort of built into your structure or your tax planning system. So I talked in our last episode, so I'm not going to go at length into this one, but review your retirement contribution opportunities. Did you max out every vehicle available to you if you have the funds to do so? So I met with a leader last week who said, I'm just maxing out the Roth, right? Because I have so much in pre-tax. I have so much in 401k and IRA, which is great. I love that tactic because it seeks to build tax diversification for retirement. But you're also leaving a major tax deduction on the table by not taking advantage of the traditional 401k. I would much rather, if you've got the ability to do so through your plan and you've got the cash available, utilize the mega backdoor Roth. right? The mega backdoor Roth allows you to contribute and max out the traditional 401k and then contribute after tax dollars to a third bucket that auto converts to the Roth account, right? So you're getting the best of both worlds there. And again, we've got a bunch of content on that topic as well that you can feel free to check out. Next one is reassess your investment account structure. I call this asset location. Look at where income is coming from. And when I say income, it doesn't necessarily mean like you're taking withdrawals. It might mean that you have specific investments that are actually producing taxable income, right? So the idea around asset location is take tax inefficient assets, and have them housed in tax optimized accounts. 401k, IRA, Roth, 401k or IRA. And then take the more tax efficient assets and incorporate them into the taxable accounts. At minimum, that would be ETFs, low cost, tax efficient ETFs, but the higher level play is utilizing tax loss harvesting strategies like direct or custom indexing, like we talked about. Next is review your charitable giving timing and structure. If you give to charities at all, you should look and say, was last year's giving as efficient as it could have been? Okay. The important thing for most W 2 leaders is the biggest control that you have is timing. And you can certainly control the timing of charitable giving. We love to use strategies like donor advised funds or gifting appreciated securities instead of cash to charitable organizations. So let me give you an example here. Let's just say you have a nonprofit. I have a nonprofit that I do a bunch of work with, and I give to them every single year. So let's just say you're going to give them $20,000. All right. And you typically write a check or you do it over the course of the year or you donate to an event or whatever the case may be. That's all well and good. And that's very noble of you to do that. And you will get a deduction for that. But the higher level strategy is to give them appreciated stock, right? So you might have a stock that has $1,000 cost basis, has $10,000 of capital gains in it. So now you owe $10,000 on that account, right? When you sell it. And instead of selling it, taking the cash and giving it to the charity, you just gift them the security. What the IRS allows you to do there is still take the tax deduction, but now you're not on the hook for that $10,000 in capital gains, and neither is the qualifying charitable organization as long as they are, properly structured as a nonprofit, right? So that's a higher level strategy that you can think about utilizing. The other thing that we really like about donor advised funds, to my point earlier around timing, is if you have a big income year, that's when you want to contribute more to your charitable accounts. But you might be saying, well, I had a big year, but doesn't mean I necessarily want to give, extensively more to a charity. You don't have to. You can give more to your donor advised fund, take the deduction in that year, and then choose when you want to give the distributions to the charitable organization, right? And that money, by the way, is invested in that donor advised fund. And you can piecemeal it out and you can break it out into different organizations if that's how you choose to donate. Okay, so that's the charitable piece. Again, a lot more content on that if you'd like it. Next one is a big one. Review your equity compensation events. This is probably the one that matters most if equity compensation is a part of your comp package. So RSUs, stock options, and employee stock purchase programs. Those are the biggest ones for corporate executives. Obviously, there are various different types of options. Okay. So what you want to do here is you want to look at what triggered tax last year. Was it expected? Was it optimized? Did a vest land in a year where your ordinary income was already high, meaning it got taxed at the highest marginal rate? Do you have any optionality around that? Maybe you do, maybe you don't, right? But if you're just kind of keeping company equity, if it's an RSU, it gets taxed as ordinary income the moment it vests, right? Then if you leave it in the account, you're then going to pay capital gains on either on a short-term or long-term basis, depending on how long you hold it. So you want to have a strategy around that. There's two components to company equity. There's the tax strategy, which is very customized to the type of equity and their individual or family situation. And then there is the concentration risk, right? So if too much of your stock, I spoke with an executive yesterday. He has somewhere in the neighborhood of 40 to 50% of his overall net worth is invested in his company stock. Well, that's huge, huge concentration risk for a company that also funds your paycheck, also funds your lifestyle. So you want to look for ways in a tax efficient manner. It usually can't all be done at once to diversify away from that company stock. And there are a number of different ways to do that. Okay. But equity comp is one of the biggest wealth levers that executives have. Now, I'm not downplaying it by any stretch, but it's also the one that is most often mismanaged. So take a look at that and see where there are opportunities. Number 8, this is a little bit more for the future, but while you're looking at the return, I find it to be a good time to do this preparation work is to check your estate documents and your beneficiary designations. Again, this kind of feels administrative, but I've seen the consequences of getting it wrong, and they are significant. So think about, because you're now reviewing and that diagnostic document, the tax return, did anything major happen last year? Was there a marriage? Was there a divorce? Was there a new child? Did you move states? Did you have a job change? Was there a large asset shift? Was there maybe a big new account or a rollover? Beneficiary designations on retirement accounts, life insurance, brokerage accounts override your will. So even if you say, well, I got a will in place, the beneficiary designations override that. Okay. The will, and I just did a YouTube video on wills and trusts, so you can check that out. But the will comes secondary to beneficiary designations on those types of accounts. Okay. So avoid common mistakes there. Okay. We've got a few left that I want to go through. And these are more for future. These are more about like building the system. So you have like the first 3 to like do those right away. The next ones, which are like, let's check these off as a part of your structure. These are like, let's build a system so that we've got some automation involved. And we're never in that place again that I mentioned at the beginning of this podcast. Okay. So that this is what turns like a one-time checklist into changes that actually impact your return in the future. I always suggest scheduling a mid-year check-in. Schedule it right now, okay? Whether that's with your financial planner, your CPA, if you've got a CPA that's willing to meet with you throughout the year and you've got to kind of weigh the cost of that, or just do it yourself. And do it now because you've got the motivation from recent filing and maybe having a little bit of pain around the tax return, okay? Having a professional can certainly help you to avoid surprises, but there's work you can do yourself and there's great software out there to help you plan for it. But if you do it in Q4, it's too late. If you do it in April, Q1 of the next year, it's way too late. Schedule it mid-year. I like to look at June and July as timeframes to get that done. All right. Then build a simple income forecast for the year. You don't need like a massive spreadsheet here, but what is your income going to look like, right? If you've got a base salary, that's pretty consistent. If you have equity vests, especially RSUs, when do they come? When do they hit? How much is going to hit in the calendar year of 2026? What is the bonus structure like? Is it paid out annually? Is it paid out quarterly? Do you have monthly commissions? What does all of that look like? And get a clear picture on what your income is going to look like for the year, right? Maybe you have employee stock purchase program that you have some set selling windows. What are those windows? Okay. If you have any side income, you've got a side hustle or maybe an LLC that you run. If your spouse has income changes, consider all those things as well. All right. When you can see the full year coming, you can make decisions ahead of it. I always tell new clients that we work with, an abnormal income year on the high end or the low end represents a planning opportunity. Okay. Maybe you change jobs, and I've seen both cases here. Maybe there was a window where you were unemployed for a little while, so your income is lower. Well, that creates planning opportunities. Maybe it's Roth conversions. Maybe it's taking from inherited IRA accounts that you want to take a little bit more now and pay the taxes on it while your rate is a little bit lower, or the Roth conversion, same concept. Or maybe you had a really big year. Okay, well, now we need to make sure that we're absolutely optimizing every deduction we can possibly get. And maybe we're using some of those charitable strategies and utilizing them in that calendar year. Okay. And then the next one is just make one commitment around next year's return. It doesn't need to be something super tactical, but think about when you've gone through this whole experience, what is like one thing that you're going to commit to? And have that be sort of like the story you're telling yourself throughout the year. It might be better coordination across your investments. It might be optimizing the timing of your equity events. It might be doing more strategic charitable giving. Whatever it is, pick one, stick to it. And if you're working with a tax professional or a financial planner, and or bring that to them and get their guidance around incorporating it into your review cadence. Okay. So that's the list. Hopefully that was helpful for you all. I hope this episode was valuable. Like I said, we've got a lot of different content on this, including I created a checklist that has all of the tactics that I mentioned in this episode. So we created a checklist. It's available on our website at yourtailoredwealth.com in the white papers and guides section, or we will link it in the podcast notes here. Feel free to check out any of the specific content that I referenced today around mega backdoor Roth, around tax loss harvesting and efficiently managing taxable accounts, around retirement contributions, around charitable endeavors, around estate planning. We've got either blogs or videos, a lot of times both, on all of those topics on yourtailoredwealth.com. I hope you enjoyed the episode. As always, you can get all of our content, both the podcast, the YouTube, and the newsletter at makingsenseofyourmoney.com. And as always, I hope this episode helps you to live your version of a rich life. Cheers.